So as far as the investment piece, we're always looking at it from the risk and return perspective, meaning that is there a way that we can take less risk with our investments and get, achieve the same return? Or is there a way that we can, take the same risk but have a higher return than the benchmark that we're mapping against? And, that's another, I think, point of confusion a lot too, is just by nature, a lot of investors will compare their portfolio with what the S&P 500 does or what the Dow does. And partly that's because that's what you hear most of in the news, but that's not necessarily, an appropriate benchmark or appropriate comparison, because that's just a bucket of 500 US large cap stocks, for example, the S&P 500. And your strategy might be different. You might be looking to generate income, or you might be, 80 years old and trying not to run out of money, or vice versa. You might be younger and be able to be more aggressive than that. So, but what we do is we assign a benchmark to every portfolio that we're managing. And it's really just to compare or measure and see how are we doing on that risk and return perspective with how we're managing things.